The next topic is two-bar reversals. In many instances, two-bar reversals offer a sharp, abrupt reversal in trend and are therefore quite powerful. The characteristics of these patterns is as follows. They need to be preceded by a strong and persistent trend. Since two-bar reversals are often followed by dramatic reversals, it's more important for them to be preceded by a strong rally or reaction than most of the other one- and two-bar formations. Both bars should stand out as having exceptionally wide trading ranges relative to previous bars. Once again, wide bars reflect volatility and emotional exhaustion. The more we can see this type of action, the more confidence we can have in the power of the pattern to signal an important reversal. The opening and closing of both bars should be near the extreme points of the bar. So that means the opening of the first bar should develop around the low. As the bar proceeds, people get more and more bullish, so by the end of the bar, the price closes on its high. The second bar opens on this same optimistic note, at the high, though we don't know it at the time. Market participants are expecting more of the same, and sometimes prices exceed the previous bar's high. However, by the end of the bar, prices close towards their lows. Thus, everyone who holds a position and has bought during the formation of the bar is going home with a loss. It's important to reflect on the total and unexpected change in sentiment that's taken place. Longs are locked in at tops and shorts at two-bar reversal bottoms. An expansion of volume on both bars enhances the concept of a change in sentiment. High volume after a strong trend is also indicative of buyer or seller exhaustion, depending on the direction of the previous trend. It also means that more traders are locked in with a loss at the pattern's completion. In this instance of a top, a stronger signal is given if the second bar has greater volume than the first, as that is indicative of selling pressure. Note also in this example, the second bar is also an outside bar, and this adds even more to the idea of a real change in sentiment and is doubly bearish. A lot of the time, two-bar reversals are followed by an immediate sharp move as the price literally reverses on a dime. That's what's happening in this diagram. However, there appear to be equally as many occasions when a small retracement move develops prior to the real trend emerging, like this. The red line marking the top of the retracement in this example has been termed a resistance zone, as it occurs at a top. The retracements can be as little as 1 bar, or as many as 3 or even more. However, the higher it goes, the weaker the pattern is likely to be. Now, I don't have any hard and fast rules as to the degree of the retracement that's allowable, but 50% appears to be a good starting point. As a rule of thumb, I'd say the smaller the retracement, the greater the ensuing decline is likely to be, and the higher the probability that the pattern's going to work. After all, if there's been a dramatic change in sentiment, we don't want the price to act indecisively, since other things being equal, indecision will indicate a weak signal. In view of that, let's lower the resistance zone in this example. On the other hand, when a resistance zone develops after the completion of a two-bar reversal, it does offer a good place above which relatively low-risk stops can be placed. The retracements also offer the opportunity to enter a trade at a price closer to the extreme of the two-bar reversal. Since the protective stop loss should be placed just beyond the extreme point of the formation, a retracement also reduces the risk associated with the trade. The same principles work in reverse for a two-bar reversal at a bottom. Here's an example preceded by a sharp reaction, culminating in two wider bars, the first of which opens on its high and closes on its low. The second opens on the low and closes near the high, approximately where the pattern started. In this case, the retracement finds support at the support zone, and the less of this activity, the better. It again helps if volume expands, because this then becomes a form of selling climax. This pattern doesn't have much volume, but I can take care of that. Even better because the second bar is accompanied by more volume than the first. Finally, all these patterns work better if we can get some confirmation, and that was definitely the case when the price broke above this trend line. This chart features a 5-minute bar for the S&P. Note that the first bar starts off with an opening close to its low and the previous close, and then moves on throughout the session to close very near to its high. The second bar does the reverse by opening at its high and closing at the low for a net zero-sum game. This was followed by a nasty decline, but in this case the resistance zone was too high to suggest that the pattern may not have worked. I'm showing you this example of US Bancorp, not so much for the 2-bar reversal, which was okay, but not overly impressive. It's the volume, of course. These 2 heavy days meant that a lot of people were trapped with a loss. Not surprisingly, prices fell quite rapidly after that. Here's a great rally above this green resistance trend line. The price opens on its low and finishes on its high for a decisive breakout. Looks good at this point. But if I uncover the next bar, you can see that it retraced all of that ground and closed back below the resistance trend line. The whole move was a whipsaw, and as so often happens with them, an above average move develops in the opposite direction. Also, it's a double whammy because the whipsaw is also a 2-bar reversal, which adds greatly to the negativity. Be on the lookout for 2-bar reversals that result in whipsaws. They're usually a great place to anticipate a very strong move. It's not many times that technical analysis will help you to predict the character of a move, but whipsaws are one of those exceptions. Not every time, of course, but on most occasions. Sometimes it's a good idea to look at time frames other than the one you normally focus on. In that way you'll find that more is revealed. Here's another example with advanced magnetics. See how the price formed a 2-bar reversal. Not a classic one because the second bar closed some way from its low, but certainly around the first day's opening. That second day was also an outside bar as well. This is what happened next, a nasty decline. But wait, there's more, because this next chart will put the whole thing into perspective. In this case, the 2-bar reversal was a break above this trend line. The second day closed at the line, so the pattern was not a whipsaw. However, the bearish connotations from this formation were such that it resulted in a whipsaw. Clearly this was a situation to be avoided, unless you'd been lucky enough to have gone short. Here's a daily chart for Abbott's Labs. Not much going on inside of that ellipse. Nothing to suggest that prices might be weak for a couple of days. Now let's look at the same period, but this time with an hourly chart. Now you can see that a sharp rally preceded a 2-bar reversal. That reversal indicated potential weakness for 5 to 10 bars, hours in this case. Note also the outside bar just here that told us prices were likely headed lower. If we were thinking about going long based on the daily chart that we saw before, both of these events would have told us to hold off. Neither of them were major game changers on the daily chart, but the hourly chart could certainly help with our tactics. If we now move down to an even shorter time span, 10 minutes in fact, these 2 ellipses contain the 2-bar reversal and the outside bar from the previous chart. Not much in the way of a signal here. The moral of the story for anyone trading 10-minute charts is to take a look at those 30-minute or hourly charts. They may be giving you a message that's not being broadcast by your 10-minute bars. Sometimes these patterns develop at major junction points on both the intraday and daily charts. This is because the 2-bar reversals, or any other 1- and 2-bar pattern for that fact, can act as dominoes or reverse dominoes. This chart features daily price action for Petrobras, the Brazilian energy giant listed on the NYSE. The bottom panel shows a smooth oscillator, which changes direction every few weeks or so. Sometimes we're left in doubt as to the changes in direction, but at other times a 1- and 2-bar price pattern, such as a 2-bar reversal, can provide the clue. In this chart, we see the price complete a nice inverse head and shoulders pattern. However, while the oscillator is rallying, it's also moderately overbought. Adding to the woes is the 2-bar reversal, which forms on the breakout. And while it doesn't close underneath the breakout trend line, it does suggest downside activity is likely. The next day the price moves back into the body of the pattern and then confirms the whipsaw break with the downside penetration of the October-April dashed uptrend line. This action of course reverses the delicately balanced RSI, and a 4-week decline is signaled. It's not that the 2-bar reversal caused all this, it just happened to be in the wrong place at the wrong time. Let's say you're thinking of buying the Dow Jones Transports. You know from experience that the Smooth Momentum Indicator, the KST, signals rallies lasting on average about 4 to 6 weeks. That is when it reverses to the upside. Right now it's moving sideways with a slight upward bias. What are the chances of it triggering a buy signal so we can take advantage of this oversold condition? Well, if I uncover the next day's trading, you can see that the price has completed a bullish 2-bar reversal. That should be good for a 5 to 10 day rally. If so, that will almost certainly mean that the delicately balanced KST will go bullish. As you can see, that assessment was right on the money. You can also see that the price experienced a small retracement, giving us plenty of time to get in under quiet market conditions. Summary for 2-bar reversals. 1. 2 very wide bars of similar size preceded by a persistent up or downtrend. 2. The first bar opens near the low, closes near the high. The second bar opens near the high and closes near the low, and vice versa. 3. Reversals are of a short-term duration but are often dramatic. And 4. They occasionally result in domino effects.